Lee family. 2022 was a very eventful year for them, from being struck by lightning to having to go through treatment in Hawaii to donating an obnoxious amount to college. And now it's time to prepare their income tax returns. So let's see what the year brought to these two middle-income individuals that brought their tax liability down by almost $1,000. Jane Lee is 65 and she's blind, so she's retired. Jim Lee is 66, but he still works as a professor of biology at Atlanta Technical College. Because he's such a nerd, he loves walking in the park and collect tree leaves for his future herbarium collection. Similar to this. One day he was walking around as usual under the trees when all of a sudden a ball of lightning struck so hard the tree under which Jim was standing caught fire and he lost consciousness. Thankfully, an emergency was called and he was transported to the closest hospital that cost him $3,000. Because Jim is an elderly man and had a few chronic diseases already, the lightning exacerbated his conditions. He needed a special surgery, but unfortunately the hospital couldn't perform it, and the Lee family was recommended to go to Hawaii to a specialized hospital with first-class doctors and technology. For whatever reason, Hawaii specifically had that technology there. They bought the last-minute round-trip tickets to Hawaii for $1,000. Thankfully, the surgery went successfully. Jim saw a few doctors and he was prescribed some medications. He paid $3,200 to doctors, the surgery was $15,000 and the prescription cost them $600. While seeing the doctors after the surgery, they had to stay in Hawaii for a few nights, 3 to be specific, before going home. So they found a modest accommodation. Modest is the key word here. And they paid $2,100 in total. But not so fast, you cannot deduct the entire amount for lodging. The specific item is limited to $50 per night per person. Even though Jane didn't receive any treatment or care, we still can account for her because she was accompanying her husband. This gives us $50 times 2 people times 3 nights, giving us a $300 total of qualified medical lodging expense. Thankfully, Jim paid $5,000 of medical insurance, which reimbursed $18,970 of his medical expenses. The total qualified expenses totaled to $27,100, out of which the insurance reimbursed $18,970. Insurance reimbursements have to be subtracted from qualified expenses, which gives us $8,130. This is the amount that the Lee family paid out of pocket. Wait, this is not deductible yet. Medical expenses are limited to 7.5% of adjusted gross income. So what is their adjusted gross income? Let's look. Jim receives a W-2 from the Atlanta Technical College and he makes $50,000 in salary. Because Jim is 66 years old, he also receives some distributions from his 401k plan. 401k plans are normally funded with pre-tax dollars, so the entire 401k distribution in his case is fully taxable. Jane doesn't work, she doesn't have a W-2, but she also receives 401k distributions. So in total, they have $50,000 of Jim's salary and $19,000 of pension for 2022. They didn't receive any Social Security benefits in 2022 because they would like Jim to stop working at some point and then have Social Security benefits replace his salary income. So that gives their total income of $69,000 for 2022. They didn't have any adjustments, so the adjusted gross income for the Lee family for 2022 is $69,000. 7.5% of $69,000 is $5,175. This is the amount of medical expenses that is not deductible on Schedule A as itemized deduction. Only the amount above $5,175 is deductible. So we have already figured that $8,130 was the expense out of pocket for the Lee family in 2022, and the difference is $2,955, which is the amount of deductible medical expenses that we can put on Schedule A. Next up is state and local tax with a nice abbreviation of SALT. Let's assume they live in Georgia and their personal home real property tax is $2,000 for the year. Obviously, this entire case and numbers are made up, so if $2,000 of real property tax per year is not reflective in Georgia, I apologize, this is for demonstration purposes only. In addition to real property tax, we can subtract Georgia income tax that the family paid. From W-2s and 1099 forms, let's assume they were withheld $3,700 from their income for Georgia purposes. That gives us $5,700 of deductible state income taxes that we can put on Schedule A. Next up is the interest that they paid on their personal residence. Let's assume that they have a debt, the current home acquisition debt of $200,000, and let's assume that they paid $8,000 of interest. In addition to that, they also paid interest on their credit card of $300. Unfortunately, that is not deductible. The last item we're going to discuss for today is probably the most interesting and most complex at the same time, and that is charitable contributions. Because Jim was struck by lightning and he survived, and Jane was so worried about him, they became very charitable for the entire year, and they were giving a lot of contributions to various parties. One day, Jane was walking on the streets of Atlanta, Georgia, enjoying herself when she saw a homeless person who was starving. So she gave him $100 so he could buy himself some food. Unfortunately, that is not deductible. The amount of money that you give to a particular individual, even if that individual is really in need of money, is not deductible. In addition to that, Jane donated $1,000 to the American Red Cross, which should be fully deductible because that is a public operating charitable organization. However, it is limited to 60% of AGI, meaning that if AGI is $69,000, you multiply by 60% and the resulting $41,400 is the maximum amount that you can donate and subtract on your Schedule A. If you donated more than $41,400, then the rest carries over to the following years. Jim and Jane attend church and decided to donate some used clothing. From a thrift store shop, they derived the value of their clothes of $100. That should be also fully deductible in their case because donating non-cash items to charitable organizations are limited to 50% of AGI, meaning that the maximum amount of non-cash items that they can donate to a public charity is $34,500. Obviously, 100 is much less than that. We shouldn't have any problems. By the way, I should put a disclaimer that what I'm discussing right now is by no means a complete picture of charitable contributions and their rules and limitations, because there is a lot of exceptions. It's very difficult to calculate for individuals, but for their specific purpose, for the Lee family, this is how it goes. Sometime during summer, Jane also volunteered at the Salvation Army and put in 3 hours of her work. If we assume she charges $25 per hour of work, she technically donated $75 to the charity. However, services are never deductible. So the amount of time that she spent at the Salvation Army volunteering is completely disregarded for tax purposes. However, she spent $35 on gasoline doing the work for Salvation Army, and this $35 that she paid out of pocket and was not reimbursed is deductible. So we can put this on Schedule A. And finally, on December 23rd, 2022, Jean and James Lee decided to donate some stock to Mary's College. It is a good college, by the way. Check it out. I went there. They decided to donate 250 shares of Google. They purchased the Google shares sometime back in 2019. So we know that they held these shares for longer than 1 year. And because this is a publicly traded stock, we can subtract the entire fair market value of the donation. However, of course, there is a limitation. And for donating stock, the limitation is 30% of the AGI. 30% of 69,000 is 20,700. That's the maximum amount that is allowed to be subtracted from their taxes. And they decided to donate 250 shares. By the way, Google did a split sometime in 2021 or 22, I don't remember. So in case you were wondering, they decided to donate an enormous amount of shares. And going into Yahoo Finance, I can see that the shares were trading at the highest $90.10 and the lowest $87.62. So I take an average of these two values and I derive $88.86. That's the average value we're gonna be using. Multiply the number of shares, 250, by 88.86, which is the average trading price for December 23rd, the date of the donation. We derive $22,215. That's the fair market value of donation. But of course, there is a limitation, and in this specific case, the limitation is 30% of AGI, meaning that $69,000 times 30% is $20,700 is the maximum amount that you can subtract on your Schedule A as a charitable contribution to Mary's college. However, we know that they donated $22,215. So they donated more than what the limitation is. We cannot put more than $20,700 on the Schedule A, so that means that the remaining $1,515 gets carried forward for the next 5 years. So they will be able, hopefully, to use that amount next year if they decide to itemize, obviously. Speaking of itemized versus standard deductions, obviously the Lee family is itemizing this year because they had significant medical expenses. They paid home mortgage, they paid the interest, and they donated an enormous amount of money to various charities. So let's go through their tax return and specifically Schedule A. Also, remember the $100 worth of used clothing donation to the local church? Looking at Form 8283, which is mandatory to file if you donate non-cash items, the $100 worth of clothing is limited the same way as the shares donation. So from Schedule A, you can see that the maximum amount of donation on this line here is $20,700 because that is limited to 30% of AGI. The rest is being carried forward for the next 5 years. Here's a very quick wrap up of Schedule A, the itemized deductions. As you can see, the medical and dental expenses of $2,955, the taxes that you pay. By the way, I forgot to mention that the salt taxes are limited to $10,000 per year, but in our case it's $5,700, so we're good here. Then we have $8,000 of interest paid for their main home mortgage, not the credit cards. And then we have the charitable contributions here. So the total amount of the itemized deductions is $38,390. Okay, let's quickly walk over their 1040 SR form, which stands for senior because they're elderly individuals. You can see reportable W-2 wages of 50 grand and 19 grand of the taxable pension, giving us an AGI of $69,000. The magical number is here, as you can see. And then we have the $38,390 of itemized deductions that we've just discussed, which derives us to the taxable income of $30,610. And from that amount, we can see the tax calculated. The total tax obligation for 2022 for the Lee family is equal to $3,264. That's the taxable liability for the year for the family. Okay, so that was useful but not very enlightening because we don't know what would have happened and what their tax liability would have been if they used the standard deduction, if they didn't have all these medical expenses, if they didn't contribute to charity as much. Their itemized deductions would have been lower than the standard deduction, and in that case we would use the standard deduction because we're allowed to use whichever deduction is higher. So here you can see the version of the tax return with the standard deduction. I'm not changing anything, so you still see the same wages, the same pension, and the same AGI amount. However, we're using a standard deduction, and so the amount on line 12 is $30,100, and that is basically comprised of the standard deduction for married filing jointly. For 2022, the amount is $25,900. So you're gonna ask me, okay, so if the standard deduction is 25,900, why are we showing 30,100? Well, don't forget that Jim is 66 years old, so he's over 64, which means that he gets an additional standard deduction of $1,400. And then Jane is also 65, so she's also over 64, so she gets additional $1,400. But in addition to that, she is also legally blind. Remember, she can't even work. So for blindness, she gets another $1,400. So the total standard deduction, accounting for their age and the legal blindness of one person, we get $30,100 of the standard deduction for this year. And that gives us a taxable income of $38,900. As you can see, it is larger than what we had in the previous case. And that, of course, resulted in a higher tax obligation of $4,260. That would have been the total tax obligation for the year for the family if they used the standard deduction instead of itemizing. So as you can see, under the itemized deduction scenario, their tax liability for the year is $3,264 as opposed to $4,260 if they use the standard deduction, giving us a difference of $996. And in case you're still here, let me introduce myself, yes, at the end of the video. My name is Lilia, I'm a New York licensed CPA, and on this channel my goal is to empower you by uncovering various US income tax topics and broadening your perspectives. While the videos and the channel overall are informative, they're by no means a complete tax guide and should never be taken as professional advice. My videos are also not educational and not eligible for CPE. With that said, I hope you enjoyed this video and found it useful, and I hope to see you in the next one. Bye!